Hey, it's Mike from the HomeHappy team here to deliver you some great news. The Bank of Canada dropped the overnight rate by 0.5%. That means that prime will be dropping from 6.45 down to 5.95. Obviously, good news for anybody in a variable or anybody with a loan that's based on prime. And going forward, we expect this rate situation to continue. We're going down. So let's just start with what it looks like for you. If you were paying on a $500,000 mortgage previously, way back at the top of the rate, it was roughly $33.58 a month. It's now gone to $29.58. Doesn't sound like a ton of money, but that's $400. $400 over a year. That's almost $5,000 you're saving. And we expect this number to continue. Let's talk about that more. So here we're talking about some situations that are continuing. Basically, what's happening is we're in a recession. So the US is sort of in a recession. We're sort of in a recession. I mean, the amount of immigration we've had is sort of blocked the normal numbers. Normally it's 2 quarters in a row of negative growth. We haven't had 2 quarters in a row of negative growth. However, the growth is 0.1%, so it's tiny. So I think for most people in their day-to-day lives, they know we're in a recession. Prices are up. Employment seems to be going. Unemployment is rising. Everything costs more. People aren't happy. So with that in mind, when you have a recession, generally the Bank of Canada's job is to lower rates and to try and get the economy going with lower rates. So that said, moving on, this is a rate forecast that I like to look at. This overnight target rate in October before the rate drop is 4.25. They expect by December that's going to go down to 3.5. So basically they're saying after this half point drop today, we're going to have another 0.25% in December. And you can see out into the end of 25, they're expecting it to go down to 2.25. So that's 2% from where we were yesterday. That's significant. That means that you're going to see prime. Some people are actually predicting a little more aggressive, but even another 0.25% below that. So that would be 2% overnight, which would make prime roughly 4.2%. So if you are in a fixed rate, it's a little bit different story. If you go down here, the bond yields are what fixed rates are based on. Basically add 2% to this or 1.5%, depending on what you're looking at. This is a 10-year, this is a 2-year. So they're saying right now this is around 3.29, and they're predicting way out that it's going to actually go back up to roughly 3% on the short term, but the long term one is the one to look at. This is 3.26, and they expect it to go down slightly, maybe a quarter, but then back up. And what that tells us is that we're kind of in a weird window where the 5-year fixed rates aren't going to go down a lot more. At least that's the forecast. And what is going to go down is the short term fixed rates. So short term fixed rates are probably what you would pay a penalty on if you were going to break your fixed rate mortgage right now. The interesting thing is that you could look at moving from a fixed rate into a variable rate with the rates staying where they are, at least in this window right now of opportunity, is that you could pay less penalty now than you would down the road, possibly. And if that's the case, then maybe you move from a fixed rate scenario into a variable rate, ride the rates down, and then look at locking in down the road, which is something we should talk about. So it's really about possibly changing your mortgage plan, reviewing it anyways. Super important to think about. A couple more quick graphs I want to show you. This is the bond yields as of today. You can see bond yields have actually gone up over the last 5 days. And over the last month, they were down and then they went back up. This is because of the U.S. The U.S. is in a strange circumstance. Like I mentioned before, we don't think 5 years are going to go down very much. So in this scenario, 5 years are probably 5-year fixed rates are probably less of a great play. Probably better to go looking at variables. Comment here from the TD Bank. This won't be the end of rate cuts, even with a succession of policy cuts since June. Rates are still way too high given the state of the economy. To bring rates in better balance, we have another 150 basis points in cuts penciled in through 2025. So that's just comparing to what the other guys said. So in general, if you're in a variable, great. Let's either talk about what discount you have on your variable or when it runs out. Those are things to make sure you're set up for. And if you're in a fixed rate, if you're comfortable, great. But if you're thinking about it, now might be a better time to do a change than to wait too far down the road. So that's it for Mike Lloyd and the HomeHappy team. Thank you for watching, and we are here to help.